Good afternoon and welcome to the ARGENTEX Group PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Harry Adams, CEO. Good afternoon, sir.
Good afternoon. Thank you everyone for joining us on this very sunny Thursday afternoon. My name is Harry Adams. I am co-founder and CEO of ARGENTEX, and alongside me I have Joe Stent, our CFO, and David Christie, our COO. If we could move on to slide 2, please, or slide 3. What's the next one? So just a quick order of play. I'll start off with a company overview, talk about the investment case. I'll then hand over to Joe, who will take us through the numbers. Who will then hand over to David to take us through the growth strategy and finish with me on the summary and outlook. So just like to open with some key takeaways from the reported period. Firstly, these interim results evidence the successful execution and implementation of our growth strategy, made all the more impressive given the challenging trading conditions that we've experienced since January. This record, more diversified revenue has not come at any cost, however, with margins in line with expectations, which has been consistent throughout this investment cycle. The swift adoption of new products via new delivery channels not only improves our earnings quality, but also further de-risks the resilient business model. And coupled with our A-grade regulatory permissions and strong foundations, this makes us one of the most credible non-bank providers in this vast market, which is ripe for disruption. So on to the next slide, please. So hopefully you're, and the next one, please. Yes, hopefully you're familiar with the fundamentals of the business and the tracked our journey from a low-tech, high-touch FX brokerage to where we are today, a high-touch, service-led, tech-enabled currency management and payment specialist. This transition has been driven by addressing evolving customer needs through focused strategic investments over the last 18 months. In this time, we've made some significant improvements to the business, but what has not changed is that we remain debt-free, well-capitalized, and cash-generative. We have offices in London, Amsterdam, and Sydney that between them house 165 staff, led by experienced leaders with a proven track record. We've established specialized teams in our core markets, offering our clients, who tend to be on the more sophisticated end of the spectrum, a growing suite of products delivered via our currency management and alternative transaction banking divisions. We generate revenues through FX spread, payment charges, and annual account fees. And we also garner interest on balances, which has its own line item in our P&L. We continue to scale the business organically, taking a risk-based approach. Our client base and product offering has never been so diverse, meaning that we are not overly exposed or reliant to any one sector or currency. The bar chart in the top right serves 3 purposes. Firstly, to illustrate that the company's organic revenue growth has been solid since our IPO in 2019. Secondly, to demonstrate the stickiness of our clients is improving through the increasing repeat business bars that you can see in green. And finally, to show that since the overhaul of our sales and marketing strategy, our sales pods are hitting their stride with a 63% increase in new business, half on half. On to the next slide, please. So the opportunity in front of us is rather unique. According to Allied Market Research, our addressable market for B2B currency management alone is absolutely vast at $150 billion. It's also estimated to be growing around 10 to 15% year on year. The market remains highly fragmented, with no one player owning more than 1% of market share. Historically, customers have been wed to dealing with incumbent banks, perceiving them as safe and secure, and the only viable way to move money. But even with this mainstream shift in behavior that we've experienced in the last 20 years or so towards challenger banks and disruptors, it's estimated that 85% of UK corporates still use the high street bank for their currency management. from who they receive poor pricing, little flexibility, and a lackluster service. Banks client onboarding is also arduous and incredibly slow, meaning more and more corporates and institutions are looking outside for credible alternatives who are well capitalized and can offer a high level of service with a robust technology platform. Credibility can't be bought though, it's got to be earned. And over the last few years, we've worked tirelessly to establish ourselves as one of the most credible non-bank currency specialists, being the only UK listed non-bank that is regulated to hold client money, that owns both an e-money and investment license, a one-stop shop for all regulated and unregulated activity as stipulated by the FCA. Our European license is also from a tier 1 regulator, which is a true differentiator for us when we're acquiring clients and passporting our services across Europe. And with these solid foundations, as we continue to innovate our technology and products, the addressable market only gets bigger and less competitive, increasing the opportunity to garner wallet share. On to the next slide, please. So this slide illustrates our 3-year journey from single product, single office in 2020, where we were only offering UK clients currency management through spot and forward via the telephone, to where we are today, a service-led, tech-enabled provider of currency management, payments, and virtual accounts. We're in the very early stages of monetizing these products, highlighted in amber. However, given the impressive early traction we've made, it is safe to say that the decision to invest in digitalizing this business whilst retaining that high level of service was certainly the right one. Our alternative transaction banking product has opened up a completely new revenue stream, and as David will cover a little later, is only the second in a suite of product developments that once built will result in us becoming a true global treasury solution for our clients. I now hand over to Jo to take us through the financials.
Thanks, Harry. So if we can go on to the next slide, please, and next again. So starting with the summary results for what has been a strong first half performance, revenues have increased by 28% to 25 million, with a notable contribution from new business. New business revenues increased by 63% and now represent 23% of total revenues compared to just 18% in H1 22. Adjusted operating profit is up 13%, supported by enhanced product mix and efficiencies generated in the business, providing the operating leverage to self-fund investment and growth. Number of clients trading and new clients trading grew in the period, as can be seen on the chart. However, the corresponding increase in average revenues per client and new client drove a much higher overall increase in revenues, demonstrating our ability to attract higher quality clients and increase our wallet share through our enhanced product offering. Adjusted operating profit margins declined as planned in the period, with a corresponding modest decline in return on capital employed. And this is reflective of our investment in growth, as previously communicated, with all facets of the implementation plan on track. This has led to a 20% growth in employees, with 165 ARGENTEX team members on board as at 30th of June. The 13% increase in adjusted operating profit has driven a corresponding 16% increase in EPS, with reported operating profit margins held broadly flat. We can move on to the next slide, please. Moving on to key metrics underpinning our performance in the half and showing the trend since IPO, you can see that an encouraging trend continues towards enhanced wallet share as more clients are trading more often using a broader product mix. New digital products such as alternative transaction banking now drive 5% of revenues, with our structured solutions product offering driving hedging up to 61% of revenues. Although spot revenues have declined as a percentage of the total, cash generation levels are maintained by the fact that options premiums are typically paid up front. And taking all new products into account across both digital and structured solutions, these now represent 15% of revenues compared to just 9% in the last half. These higher margin products provide enhanced profitability and provide incremental operating leverage as these products scale. Move on to the next slide, please. And as we get into the financial statement summaries, we can see here the key highlights already reviewed running through the summary P&L. As noted, revenues increased by 28% to 25 million, leading to adjusted operating profit of 5.4 million, or a margin of 22%. The decline versus prior year is in line with plan and reflecting our investment in growth as previously communicated. It's also worth noting that revenues in the prior half and prior year far exceeded expectations. Therefore, this was reflected as in the bottom line as investments progressed in line with plan. Reported or unadjusted operating profit increased by 16%, driving a corresponding, as mentioned before, a 16% increase in EPS. And reported operating profit has decreased by a lower proportion to that of adjusted operating profit due to one-off expenditures such as the setup of overseas offices incurred last half, but not in H1 23. EBITDA margins were largely maintained in the period, driven by higher gross margins obtained from our enhanced product offering, as well as other efficiencies created in our operating model, offsetting investment and growth, in addition to the capital nature of a portion of that investment. Average headcount increased by 44%, with hires made focused on front office, international expansion, or technology and product roles. As you can see, the front office back office split has shifted downwards slightly, albeit with support functions now including technology. Moving on to the next slide, please. This next page delves into a little more detail and is more reflective of our business model compared to statutory reporting. When all variable costs, including variable compensation, is classified as variable costs, you can see the true gross margin and flexibility within our operating model. On this basis, gross margins increased by 4%, demonstrating the impact of our enhanced product mix, with new higher margin products now representing 15% of our revenues, as previously mentioned. In addition, we have maintained a disciplined approach to costs, including our review of total reward. This is manifest in the P&L through reduced variable compensation, now balanced with potential rewards associated with the recently launched LTIP to align with shareholder interests. We've begun to garner interest on balances, as seen in other income, which is in line with other e-money institutions. And although we've benefited from this income, it does not form a core part of our three-pillar growth strategy. All facets of our investment and growth are rolling out in line with plan, all of which is self-funded through consistently high levels of cash generation, with enhanced gross margins providing the operating leverage to offset any impact on EBITDA margins in the period. And due to the capital nature of a portion of our investment and growth, this has resulted in an increased depreciation and amortization charge and a subsequent planned decline in adjusted operating profit margins, albeit adjusted operating profit has increased in absolute terms by 13%. Next slide, please. Turning now to balance sheet and cash. Our balance sheet has grown modestly over the period, with net own cash up by 3 million. Other notable movements include that within PP&E, reflecting the growth in footprint across group and European HQ. As a reminder, own cash, as shown on the right-hand side, is adjusted for amounts owed to clients, which is included within trade and other payables on the face of the balance sheet. And as can be seen from this analysis, we have generated a net amount of 3 million in cash after self-funding of growth initiatives, supporting BAU activity, as well as ensuring we have sufficient liquidity and regulatory capital amounts held in the business. Next slide, please. This slide is a summary statutory view of our cash flow statement, which shows that outside of any movements in client funds held, we generated 7.6 million in cash from operating activities. This is after any investment in growth through operational expenditure. This was generated across a 6-month period compared to a similar amount having been generated in the previous 9-month reporting period. Investing activities reflect the capital elements of our investment in growth and include those made in technology and products, in addition to the expanded footprint across group and European HQ. The business remains debt-free, with financing activities including any lease payments in the period, in addition to any dividends paid to shareholders. Next slide, please. As previously mentioned, we've maintained consistent levels of short-term cash generation as we expand our product offering and increase revenues, offering us the ability to fund our ambitious growth programme. This is possible even with hedging now representing 61% of our revenues, a significant increase versus prior years, due to the fact that options premiums are typically paid up front. We have not altered our risk appetite, with client concentration levels remaining consistent with prior years, in addition to continued high proportion of trading transacted across the 3 major currencies. And then the next slide, please. So this provides a more detailed view of the gross cash generated in the period and how this has been utilised. As can be seen, over 30% of cash generated in the period has been directed towards growth within each of the 3 pillars of our growth strategy, with the remainder fueling ongoing BAU activity, as well as retaining healthy levels of liquidity and necessary regulatory capital requirements. So in summary, a strong first half performance with benefits from our enhanced product offering already bearing fruit, and a notable performance from new business in the period. And this, coupled with continued high levels of cash generation, has enabled us to invest in growth, driving enhanced quality of earnings and maintaining a balanced approach to risk. And with that, I'll hand over to David to take us through our growth strategy in more detail.
Thank you, Jo. Next slide, please. As mentioned in previous presentations, there were 3 phases of our technology strategy. The first phase was to launch our online trading platform where clients can trade both spot and forward contracts in over 50 currencies to supplement the offline service-based proposition that we've had in place for about a decade. The second phase was the launch of the alternative transaction banking product, which happened in late March. And this gives the clients the ability to collect funds and hold balances in 15 currencies from a single virtual IBAN account. And these virtual IBANs are held with tier 1 banks and are in the name of the client. And as highlighted previously, can be used by both institutional as well as corporate clients alike. For example, this can allow funds to make capital calls from investors or for an exporter to allow their international clients to pay in local currencies. These funds can then be converted and paid out globally as needed, all from within the single platform. This combined digital offering now generates 1.4 million in revenue in the period, which is an increase of 75% year on year. It accounts for 5% of group revenues, as Jo mentioned earlier, and is now consumed by 12% of our clients. Next slide, please. Digging deeper, we can see that the number of clients using the digital platform increased 62% year on year to 396 clients. This includes 43 alternative transaction banking clients set up within the 3 months from launch. 80% of these clients were net new clients that would never have traded with us before if we didn't have that virtual IBAN capability. Impressively, these clients account for 14% of all new clients onboarded in the period, showing solid appetite for this proposition in only 3 months. Additionally, the number of trades being completed increased 88% year on year, with 5% of those digital trades attributable from our alternative transaction banking clients. Of note was average revenue per trade for alternative transaction banking, which came in at 1.3k versus £242 for a digital trading only client, demonstrating the benefit of the combined proposition. And even though alternative transaction banking has only been in play for 3 months, FX revenue from the product was 22% of the total digital revenue and 34% if you take fees and interest into account. This revenue would not have been possible without the combined proposition being made available. The compound effect of this is that more clients trade more often, but this is increased product offering is driving it, the average revenue per client up for digital proposition up 5-fold to 13k. So we're extremely pleased with the performance of our digital products, which are ahead of management expectations. And the coming period will all be about accelerating momentum. Next slide, please. Phase 3 of our technology strategy is all about building specific products that meet the unique needs of our various segments that we serve. As part of our client-driven approach, we interviewed 600 CFOs from non-customers to really understand what keeps them awake at night and what their biggest challenges are with respects to FX. These insights, coupled with the feedback we get from our existing clients, is helping us prioritize and build our future products. New developments will include helping our clients improve their visibility on the impact FX can have on their business, as well as help them better manage this FX volatility through improved insights and better hedging decisions. This product presents potential opportunities for inorganic acquisitions that we may want to pursue to fast track this development. Additionally, we are in the process of building a mass payments product to help larger payment-focused clients better manage their requirements. These clients have much larger beneficiary bases than our historical clients and need help managing payments more effectively. So we really need to make it simple for them to pay en masse rather than one transaction at a time, but with all the governance and control that you would expect. Mass payments is a higher margin product, which will typically yield 200 to 500 basis points versus 20 to 30 for a standard spot transaction, where speed and convenience are much more important than price. Next slide, please. So switching gears to international expansion. Our performance in Europe continues to track ahead of management expectations, with revenue increasing 108% to 1.8 million in the period. Digital adoption in Europe is more progressed at 18% of clients and is generating 11% of revenues in the region, which is double that of the wider group, showing clients in the EU have a higher propensity for digital solutions. Additionally, we are seeing great traction in selling outside of the Netherlands, with 24% of revenue already generated across the wider EU region. This combination bodes well for growth in this massive $60 billion market opportunity. Next slide, please. Digging deeper into the numbers, we can see more clients are trading more often. The number of traded clients grew 50% year on year to 181 clients, with trades up 81%. This resulted in the average revenue per client increasing an impressive 57% to 11K. You can see that the mix of product in Europe is more heavily biased towards hedging than that seen in the UK. But as we push alternative transaction banking into the region, we expect these numbers to move around a little, as we believe there is a massive opportunity to really grow this digital product across the region, given their increased propensity to use these digital solutions. Next slide, please. Whilst we wait for our Australian financial services license, we've spent the time getting operationally ready. We've put the banking and liquidity rails already in place. We've enhanced the core proposition and the system, as well as implemented governance and processes needed to meet local regulatory requirements. The sales team in Australia is already generating revenue and are building a solid pipeline of clients. And to support this, we've recently supported the team with an options dealer locally, and we will be relocating the head of enterprise solutions down there to kickstart our alternative transaction banking product in the region. So once we get this license granted, we will hit the ground running with a full spectrum of our products. Harry, over to you.
Thanks, David. On to the next slide, please. So our team and culture continue to be a differentiator and strategic weapon for ARGENTEX. It can be very challenging to retain a good culture when a business is scaling and transitioning at such speed. However, focus on our company values and employee well-being has meant that our staff are embracing this challenge. We invest in the development of our staff across the group, always trying to fill a vacancy internally if it leads to progression. Our overseas offices have aided career progression, with some staff relocating from the UK, which we encourage in order to help replicate our culture. As Joe pointed out earlier, the lion's share of the increased investment has been people. And whilst we continue to attract top talent, we believe that the bench strength of our UK senior leadership team is now sufficient for the next chapter of growth. Our sustainability strategy is cornerstoned by planet, people, and partners. Whilst we have a responsibility to lead by example in protecting the planet, we do through our partners' earthly and planet mark by planting a tree for every trade. But it is the people pillar that we focus on. Each member of staff has access to one-on-one performance coaching, with over 400 hours spent in the period focusing on the individual's mental health and well-being. On to the next slide, please. So in summary, the group delivered another record half one, despite challenging trading conditions. This is testament to the commitment of our growth strategy, which is paying dividends. Our European office was the standout performer in the half. We have barely scratched the surface in the Netherlands and are very excited about the ability to passport across mainland Europe, a $60 billion market. Our earning quality has improved further through the impressive adoption of our new higher margin products, demonstrated by the uptick in average revenue per client. But finally, what underpins this success is our wonderful team of 165, both new and old. Their belief and dedication to this business has never been stronger. So in terms of outlook, it'd be amiss of me not to mention that the market backdrop has become more challenging this year, with the seasonal slowdown across the European and institutional divisions. However, the opportunity remains unchanged. The launch of the new alternative transaction banking product and the dedicated divisions to sell and serve these products will accelerate across the UK, Europe, and in time Australia, further diversifying revenue and increasing wallet share. We will continue to innovate, investing in our technology and products, which will drive revenue and efficiencies as we focus on attracting more high-quality clients who can sell more products to more frequently across more geographies. Thank you for listening. That concludes the presentation, and I will open up to questions.
Perfect. Harry, Joe, David, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation. And Harry, at this point, if I could just hand over to you just to chair the Q&A, that'd be great.
Yep, sure, no problem. So we've had quite a few pre-submitted questions actually. So we'll go through a few of these, and then we'll go on to the online questions. So we'll crack on. You paint a picture of post-period end environment, which is very soft. Should the market be worried? No, absolutely not. So we've been very clear that the trading conditions that we've experienced over the last 9 months have not been anywhere near as good as we've experienced in the past. However, we've experienced similar market conditions to what we're seeing at the moment. And that really is very benign volatility. That is very tight trading ranges across G7 currencies. And also, there tends to be a bit of a slowdown in commitment. And we saw this through COVID as well, where if there's less certainty from clients, what they'll do is they'll probably sit on their hands and wait either to have more certainty on the economic backdrop, or it might be more certainty in the business decisions that they're making. But I think the bottom line here is that this business is not a volatility play, and we are here to operate in any market backdrop, and we've proved on numerous occasions that we will continue to do that. Yes, it is helpful, but we see a lot of volatility as we experienced last September. However, by no means is this integral to what we do. So taking it back into sort of post-period end, which I guess is sort of more about this question here. There was a seasonal slowdown. There always is a seasonal slowdown in July and August. This is, I guess, the first full year that we've had a dedicated team in Amsterdam that is selling over to our European clients. And I was warned that it was likely to slow down in August, but I guess I wasn't expecting it to slow down that much. But remember that although it's growing, our European division is growing, it still equates to a very small part of our revenue. And very pleased to see that as of late August, beginning of September, that activity is certainly picking up, and that's really sort of echoed across institutional as well. So you've seen it's been well publicised, I guess, throughout the summer months that institutional deals are down, but also I think there was a report recently saying that for the first time there's some net inflows into the UK, and the funds are starting to pick up. So great to see that. We're experiencing it. We're still up 20% from the 1st of January to the end of August, with 3 trading days in September. So no, nothing to be worried about whatsoever. How are you calculating the market opportunity? So throughout that presentation, I think I used a couple of figures in there. First of all, the size, or the estimated size of the B2B market globally, of about $150 billion by Allied Market Research, I seem to remember. And also the European market opportunity. Look, I think no one really knows how big this market is. There's a lot of guesstimates going on. You don't know how much is going to be speculative. You don't know how much is B2B. I think really the bottom line here is that the market is absolutely enormous. We have historically been focusing on currency risk management, which we've grown a great business on the back of just hedging for spot and forward, and more recently options and structured solutions. Now we have this new opportunity of entering this alternative transaction banking market, which David spent a bit of time talking about. We are only sort of 3 or 4 months into this process, and it is great to see that not only are we making good traction, the opportunity is as such that we're being very selective on the types of clients that we onboard. We don't want to onboard every single client. We still have that sort of foreign exchange requirement as sort of as a core. However, look, we are mindful that despite it not being a core pillar of our strategy, interest and interest rates are here to stay. Therefore, if we're able to garner interest on large balances, then of course we will take that, and we will drive behaviours as such to onboard those kind of clients. It's massive, huge. Number 3, how has volatility impacted your earnings this year? What caution has been baked into forward guidance given the macroeconomic backdrop? Okay, so I've touched on this on question 1 in terms of what our business is here to do. We're not here to thrive on volatility. Yes, it is helpful. We're here to sort of manage our companies or our clients' risk and trying to take out that foreign exchange noise and try and get the client to focus on covering that risk and protecting their bottom line. It is helpful, absolutely, but of course it's not integral to this business. I think it's probably worth going on from that just to say that we have obviously been investing heavily in our technology and new products, and diversified our revenue streams, which makes us even less dependent on that sort of business. So I'll probably be sat here next year, a year after, and volatility won't even be a question, because we'll be so much further on with our technology strategy. We'll be so much more diversified. We'll have more clients across different jurisdictions. The UK market dynamics won't affect this company. Is the revenue contribution of the new tech products in line with expectation for this stage in development? David, do you want to take that one?
Yeah, sure. If anything, I think it's not just in line; it's tracking ahead of expectations on a number of fronts. As you saw in the deck that we walked you through, the average revenue per client for the digital products has increased 5-fold, which is really pleasing. The fact that 14% of our clients that we onboarded in the period is attributable to the alternative transaction banking product, which we would never onboarded if we hadn't had that wider product set. And when you think about the fact that it was only there for 3 months in the period, it really starts setting the stage for some interesting dynamics going forward. Also, from a European perspective, but as I mentioned earlier, 18% of our clients, 11% of our revenues come from the digital product, and we launched our first NL-based virtual IBAN to our Dutch client, one of our Dutch clients, as part of M43. So we're starting to really see that hit the ground running, and as I mentioned, we're really positive about the potential for this product going forward, and as well as the options product that we've got. It's now 12% of revenues, give or take, and that's really developing well as well. And that's more supported by technology investment underneath the hood than what you see in the alternative transaction banking side. But that overall, package and mix and that diversification of that higher margin revenue is really, really pleasing, and we're hoping that it's going to do a lot of good in the future.
Yeah, thank you, David. Is there any inorganic growth appetite, example M&A, particularly given Alpha Group's announced acquisition? David sort of spoke about this later. So do you want to pass over the money?
Sure. I mean, I think it's worth saying that the growth ambitions that we already have laid out, I'm very confident that we're able to deliver those organically, and we continue to prove that as we progress through the investment cycle. But it always makes common sense to be reviewing options as they appear, and we would always be open to evaluating those, so long as they're accretive from a shareholder standpoint, and deliver value, then we would always be open to looking at those.
And I think, just building on that, Joe, when we look at a new product or a new strategic investment, we go through that. Do we build it ourselves? Do we partner with somebody to try and help us deliver that, or do we, should we buy something? And we'll continue to take that wide approach and make them sort of decisions on a case-by-case basis going forward.
Thanks, David. So can you explain the interest income generated during the period, Joe?
Yeah, sure. So we did garner 600k interest in the period for an interest income, which, as we explained, is a separate line item in our P&L, and it's not seen as core to our business. But obviously, we take advantage of that in line with other e-money license companies. And part of that is driven from the balances, our own balances that we hold. But as the alternative transaction banking product scales and expands, then there's sort of an evident opportunity for garnering the proportionate amount of interest as we kind of remain in that sort of positive interest rate environment.
Thanks, Joe. There's a few questions about this, so I'll also paraphrase. But are the setup costs in Europe and Australia now realised?
Yes, so I think from a setup cost point of view, as in those kind of one-off costs that we take out of the adjusted operating profit line. Yes, I would say that within certainly from a Netherlands or European HQ point of view, as well as Australia, the lion's share of those are substantially complete. As we look at expanding footprint across Europe, that may change, but I would say in the main, those are substantially completed.
Are you looking at any other geographies? Yes, of course. Overseas expansion is one of our key pillars to our strategy. We have that credible license over in the Netherlands, which allows us to passport seamlessly across Europe. The strategy here is that we have sort of bilingual sort of staff over in the Netherlands who can sell into different countries across Europe. Then as we start gaining more traction within those countries, we'll start putting boots on the ground. We'll probably have to put a little bit of compliance around them, because sort of each country has its sort of own regulatory requirements. But certainly, that's a strategy that we're executing. Further afield, we talked about Australasia. There are a few opportunities over there, namely New Zealand, but obviously we want to focus on the Australia market first. And then, of course, we're looking at other opportunities that have similar market dynamics to the UK. We like to focus on highly regulated markets, as you can probably tell from the level of regulation that we put ourselves through. So really watch this space, and look forward to sort of updating the market, firstly on Australia and obtaining that license, and then some potential new jurisdictions going into next year. Okay, let's get a few questions about operating margin here. So they've fallen. Yes, do you expect them to fall further? Where are they going? Again, paraphrasing. Joe?
Yeah, so just to take that one, we flagged about 18 months ago with the change in our strategy and introduction of our three-pillar growth strategy that we were entering into an investment period, and we're still in that investment period phase. Whilst we've seen a decline in operating margins year on year, I mean, it's just worth noting that we did benefit from much higher than anticipated revenues in the prior period. And the sort of consequential drop through to the bottom line in the previous year. So we would have guided towards around 20% with our broker last year, and delivered 25% because of that incremental revenue. And this year we are guiding towards the 23% for the full year. So while we're still in this investment period and launching those new higher margin products and entering into those new geographies, those are, although they're incrementally, or they're representing a higher and higher proportion of total revenue. So across all geographies and products, for example, those are now 23% of revenues in the half, versus 14% in the last. we're starting to see some of that benefit trickle through in terms of margin. But as we scale those products and as we scale them across those geographies, you can see that sort of natural incremental operating efficiency and operating leverage that will drop through to the bottom line. So very much the investment program is very much on track, and we're looking forward to seeing those results flow through.
Has your client base changed to develop these new products, or are you attracting new clients in addition? David, you covered this a little bit. Do you want to add a bit more?
Yeah, sure. Obviously, the sectorial mix across corporate and institutions has pretty much stayed the same, year on year. But what we are seeing is a higher quality level of client coming through. And what I mean by that is, these guys are larger. They're doing larger volumes. They're using more product. And ultimately, as Joe mentioned earlier, we're seeing a higher average revenue per client tick through. And when you compare period on period, we're really seeing a positive improvement in that. And as we continue to push into that new product and the improving sales capacity as well as the sales capability on the sales floor, we should see that improve going forward into the second half, I would hope.
Thanks, David. The outlook is challenging. How will ARGENTEX navigate this, and what do you think will be the key growth drivers? I think we've covered the majority of this in deck, but also in the Q&A. But yes, the outlook is challenging, and it has been challenging for the last 9 months. There was a lot of chatter this time last year about us entering, sort of a very large recession. That's not happened. Yes, okay, growth in the UK is down. We've still posted an increase of 28% of revenue up to the end of June, which fell through to 20% towards the end of August. Just to reiterate, we've seen this sort of, I keep calling it sort of back to school, with all these clients now sort of waking up. The beauty of what we do is trading and, well, not trading, but dealing with risk management for currencies for corporates. There's always going to be a requirement, whether the company is hedging today or hedging in 3 months. It doesn't really matter to us as long as they are hedging or as long as they are trading. So as long as the economy continues to stimulate, as long as our clients continue to trade, which they are, then there's no concern whatsoever. Key drivers are, we've been over these. Really, it's more products to more clients, focusing on the higher quality clients, as David just said, and garnering more wallet share from those clients. There's quite a few questions in here that we can't really answer regarding share price, which it's not really for me to comment on. So with that, I think we've answered all the questions we can. So I will hand back to.
Perfect. Harry, Joe, David, thank you very much for that. And I think as you mentioned, you have addressed those questions you can from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Harry, could I just ask you for a few closing comments?
Yeah, please do give us feedback. Some of the feedback last year was that we were a bit wooden, so we put up this this lovely stage behind us, and hopefully, we're becoming a little bit more personal. So please do give the feedback. It's really important to us. We read it all and we do action it. Thank you very much for your interest. Thank you for your time today, and we look forward to updating you. If not before January, we'll be back on IMC for our full year results towards April, May time. But thank you.
Perfect. Harry, Joe, David, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but as mentioned, will be greatly valued by the company. On behalf of the management team of ARGENTEX Group PLC, We'd like to thank you for attending today's presentation, and good afternoon to you all.